Hi everyone, welcome to the second part of the today's FinTech Summit. We have an esteemed panelist, Ganesh, who is co-founder and managing partner of Kona Capital. Ganesh, welcome to the FinTech Summit.
Thank you. Thanks, Devendra. It's really a pleasure to be here. Thanks for inviting me.
Thank you. Ganesh, we'll start with your background. So you have a very fascinating journey. You're an IIT grad. You did MBA from AMCAL, then started in corporate in Infosys, did MBA once again from Harvard Business School, became one of the tech entrepreneur, and then sort of became a venture capitalist. Could you talk about the journey? How did that happen? If you could sort of briefly talk about your journey.
Yeah, sure, Devendra. I think, let me see. I think now over years, I've learned to do this a little bit faster. Otherwise, we can spend a lot of time getting lost in that. But basically, I started my career, my career actually didn't start in Infosys. It started in oil and gas long ago after engineering. But I realized in 8-9 months after being in a terminal full of 400 people who were where the youngest person was twice my age and filling a lot of oil tankers, I realized that's not for me. And that's how I kind of transitioned. And after I joined Infosys, at Infosys, I was fortunate. After a few months, I actually moved to California, and I was primarily doing a lot of business development and account management for financial services, what was fintech but wasn't called fintech in those days, and digital commerce and retail. So that's kind of been a consistent theme across my career in different ways since then. But that's where that was really an eye-opening experience. I was there for a few years, and even till date, the largest fintech program that I have worked on was probably re-architecting the authorization, clearing, and settlement systems of Visa, which basically impacts all the credit cards in the world that Visa issues with its banking partners. So it was a massive program. We had to re-architect both on business and tech side, and that really opened up my eyes to the world of fintech. And being in the valley for 3-4 years really led to the entrepreneurial drive, which is when at Harvard Business School I started a company called Travel Guru along with my partner Ashwin. Eventually, we exited to Travelocity, Expedia. I took a step back and had a board role halfway through, and then started my venture journey with Greylock Partners. And essentially, Greylock was looking to start Asia and India, which is how and given my experience with Infosys and the entrepreneurial background, I basically went to try my hand at that with Greylock. And as a part of that, I pretty much used to be on a flight to India every month. Used to spend 10 days to 2 weeks here for almost 2 years. I was still based in the Valley. And as a part of that, I really started getting deeper and deeper into the ecosystem, and also started working on in advisory capacity with some microfinance and SME financing institutions. And that really opened up my eyes to the next chapter of my life. And I moved back through the 2008-9 crisis, and joined Unitas, which probably was amongst the very, very, very few institutions at that point in time, which gave me the opportunity to work on something impactful while bringing in the entrepreneurial startup and venture investing mindset to it, and hopefully something that will be a lot more impactful than some of the purely digital investments I was doing in the Valley at that point in time. And that portfolio is the best portfolio I've seen till date, including our portfolio at Greylock, which, by the way, my first 2 investments I worked on at Greylock were LinkedIn and Facebook, which was a great training ground. But of our Unitas portfolio, about eight of them are today small finance banks, 4 of them are public. And so these companies have done extraordinarily well. And that's kind of what cemented my faith in the space, saying we can actually we can back entrepreneurs who go after large problems in emerging markets. And frankly, most of our markets, 60, 70, 80% of the markets in the 14 countries we invest in today are underserved or unserved. So these are large underserved or unserved markets. So you need to have an orientation of figuring out what makes sense for the consumers, but you also need a very enterprise building mindset and a startup mindset to it, and not necessarily a development only mindset. And the one big missing piece was tech in inclusion in those days. And there are two. One was tech. The other is it was largely only credit focused. So we really said, everyday life cycle needs of people can be solved more if we integrate digital and tech and the way the world is moving, along with looking at solutions which are much broader than credit only. And that was the genesis of Kona. And yeah, now it still feels like day one, but we just been completed over 6 years. So we are getting into the 7th year now.
That's one hell of fascinating story, Ganesh. So can you also talk a little bit about Kona Capital? It's not easy for someone to start a fund. You start a fund with a couple of foreign partners, a fund which focuses on not just multiple countries but multiple continents. And you guys have been making investments across different stages across these countries and continents. So can you talk a little bit about Kona Capital story, how it came together, and like what you guys focus at Kona?
Sure. So Kona, actually Kona in Swahili means to see or to have a vision. And that was one of the things we really were aiming for, which is to start with the foundation of what is the target segment we're going after and the type of solutions which I touched upon a little bit. But you have to really see beyond the obvious to believe that the amalgamation of digital and innovative financial services can really help serve the life cycle needs of folks in all these markets. So we go very, very deep sectorally. So we invest in classical fintech opportunities. At the same time, we invest in what we call embedded finance, which could be convergence of retail and fintech, agri and fintech, B2B commerce and fintech, healthcare and financial services, education and financial services, mobility and financial services. So a lot of our investments are crossover, and number of our investments are very core financial services as well, because the theme of Kona is not finance or financial innovation for the sake of it. It's financial innovation to be able to serve or solve life cycle needs and challenges and problems and gaps of consumers or SMEs in emerging markets. So today we are in, like you said, we are in Asia, Africa, LATAM, and MENA. Investments across 14 countries. Been fortunate, we went from $0 to $500 million in assets in this time frame, onto our third fund now, and typically come in at pre-Series A or Series A stage. And the entire entire thesis is, along with all the things I just mentioned, is the fact that a lot of solutions which are traditionally accepted solutions in developed or mature markets do not necessarily work the same way in emerging markets. I mean, whether it's India, Nigeria, Philippines, Indonesia, Brazil, Mexico, I mean, you take your pick. Every market has its own complexities, and the consumers and SMEs have their own complexities. The infrastructure has its own complexities. So it was really backing entrepreneurs who know what are the digital and financial innovations which work in these markets and can really help change the lives of these consumers and SMEs. That was the thesis. And to substantiate that, we have a lot of sovereign developmental institutions of various countries and number of Fortune 100 financial institutions who are also backers of Kona, because there's true belief in the thesis that what works in developed market does not work cut and paste in emerging markets. And frankly, that's one of our biggest motivators, because in the first era of entrepreneurship in our country, if you go 15-20 years back, we have talked a lot about how a lot of, even in India, how a lot of models were just cut and paste of models which succeeded in some other countries. Has it completely disappeared? Of course not. But are we seeing more and more innovative things which make more sense for the market? Yes, absolutely. And that's true in some of the other countries as well, which is what excites us.
That's incredible to know about Kona. Kona invest across multiple countries. So that means you have a ringside view on regulation in these countries, payment infrastructure, data speeds, smartphone penetration, cost of data. And having that sort of, let's say, that kind of sort of data is quite invaluable. So when you sort of go ahead with your core goal, which is fintech driven digital inclusion, how do you decide from the country perspective? Because having all these parameters can make one country more attractive or less attractive. So could you talk about that?
Yeah, that's a great question, and it's a very tough one, because we have this constant pull and push of saying we need to focus and go deeper in core markets. At the same time, our goal is to be the hopefully the most helpful and meaningful investor for digital and financial inclusion in emerging markets. So there's always this push and pull, and as you can see, when we have countries like India and Brazil and Indonesia, etc., that we invest in, it also becomes challenging to say how do you make a decision on investing in smaller countries. Like we do have investments in Colombia, we do have investments in South Africa, right? We do have investments in Thailand. So it's a great question. We have a framework which probably goes across three or four components. One is the market opportunity in the context of the problem. That is the difficult part. It's not the macro market opportunity. I think by macro market opportunities, we'll probably not go to more than 4 or 5 countries beyond the top 4 or 5 countries we are in. So it's market opportunity in the context of the problem or the solution. Secondly, it's obviously the quality of the entrepreneurial team, and there we are not going to compromise. It has to be, it's the same bar across all these markets or similar bar. Third is the regulatory ecosystem in these markets, and in certain markets the regulatory ecosystems for certain things is just tough. I mean, like cross-border payments in some of the countries in Africa, credit regulations in some of the countries in Asia, so on and so forth. So regulatory is something that we cannot fight, especially if there's a context because of which the regulator has certain restrictions. And the fourth is the infrastructure, the digital and soft infrastructure in these markets for the entrepreneurs to capitalize on and be able to build these solutions. And there's the last one. I mean, I guess I said four, but I lost count. But the last one is, if you keep aside India, Brazil, and Indonesia, which can be large enough markets on their own, for most of the other markets, we also see the ability of the entrepreneurial team to be able to scale up beyond their core markets, because it's a more often than not, it's difficult to see how just being in Thailand or just being in Colombia or just being in Kenya can build a large enough, meaningful, successful regional player. And it's probably essential to build one in smaller markets if you want to have success at venture scale.
Sure. Ganesh, I was looking at your portfolio, and in your portfolio, we had investments, for example, Buku Warang in Indonesia, which is a bookkeeping platform for SME, Ula, which is an e-com enabler for SME, and neobanks. All of these investments have been outside India, while in each of these segments, we do have companies, and we have been having companies from last 2 or 3 years. So could you just explain your thesis when you decide to invest? Is it like competitiveness of a transaction, or is it like the market opportunity more attractive? How do you guys decide about that?
Yeah, I think it's probably more nuanced and a little bit more complex than that. And each of this, I think, is more than hours debate discussion, maybe even more. So one of the things that's been challenging in India is across our markets. India is probably the market with maximum supply of capital, and also relatively the most healthy supply of entrepreneurs. And what that does sometimes is, if there is an interesting opportunity that comes forth, we also seen that in India very soon, like for example, 2 years ago, we had no neobanks. We invested in Banco Neon in Brazil, maybe now 3.5 years ago. Banco Neon through COVID raised a 300 million round, and it's now the second largest neobank in Brazil. But when we did that investment, there were no neobanks in India. And in last 2 years, we have more than 24 which have come up. So the problem also is sometimes when we are overcrowding in at short notice, also there are multiple bets being made by investors across the spectrum very quickly, maybe 6 to 8 companies or maybe even more. It becomes challenging to say there is natural inflation, asset inflation, and there is also natural over flooding of capital, because where you need to raise 5 or 10 billion, sometimes you end up raising 25, 30, even 50. So when that happens very quickly in a market, given just our DNA and how we are, we get a little bit more cautious. That's just one dynamic. It's not necessarily only in India, but India, there are prominent examples in India of that. The second is when it comes to digibank specifically. I think having worked with the regulatory system in the country for a long time, we also we have kind of lived through the cycle of microfinance institutions becoming small finance banks, payment companies becoming payment banks, rural banks now becoming payment banks, or sorry, small finance banks, and small finance banks becoming commercial banks, and we have seen all of this. And most of this cycle, we have been insiders in some company or the other, or maybe multiple companies going through this transformation. So we know, or we recognize how hard it is to be recognized as a bank in the country. So even though we think the neobanking in itself is a significant discussion on what is a neobank. Is it the front end innovation? Is it the back end innovation? Is it the fundamental product innovation? Then being highlighted more by front end innovation. Do we have the soft infrastructure for the kind of integrations needed for a neobanking system to work? Do you have the ability to hold capital? Do you have the ability to move around capital, for which you need certain kind of licenses? Are licenses going to come easily? We don't know yet the answers to these things. But there has been overflooding in the market, right, ahead of time, and that's kind of been the challenge there. In some of the other instances that you mentioned, I think our question has been, again, we have done financial services for a long time, whether it's financial services, whether it's embedded finance and adjacencies to finance. You need to start seeing an ability to monetize in a reasonable time frame. You need to see product market fit. And in e-commerce, people can talk about product market fit only in DAU, MAU, virality coefficient, network effects, and different engagement retention metrics. When you are hitting financial services, especially if you are serving SMEs, you have to show that they will pay you for the value you deliver. It's very simple. I mean, we try to complicate life a lot, but it's as simple as that. At some point, if you are not getting paid, or if you are not seeing line of sight to monetization, I think it's going to be very hard to scale that, right? So companies run on a trajectory of performance, promise, imagination. I think part of the challenge we are having is you need to move your performance to then build on that to show the promise of what's possible, right? But I think what's happening is, while we are in nascent stage, moving to imagination is very dangerous. And I think we are having a lot of situations where companies are moving from performance to promise to imagination in early stage itself. And that's very dangerous. Once you get to an enterprise that's large enough, you can show the imagination of what's possible. And maybe it makes sense for people to take that seriously. So we are running on imagination when we don't even have monetization today. Forget promise. I mean, making a promise has become very normal on look what we can do. But we are really running on imagination, and that's kind of hard for us to assess and say we will come in at high valuations with no line of sight, or just the need sometimes. The need people feel that, look, we don't need to monetize in the short term or medium term, which is also sort of a common philosophy. And part of it comes from how digital commerce has evolved in number of markets. And one of the biggest dangers we run today is, as number of embedded or financial adjacency companies are coming up, because number of companies are realizing that fintech is a way to kind of evolve their story as well. As that starts coming up, I think translating the e-commerce culture or way of thinking entirely to fintech, I think we believe could be really dangerous. Because financial services, has been around for much longer, than a lot of other businesses. Aside from the flesh trade, it's probably the oldest trade in the world. Lending is the oldest trade in the world, right? So yes, some principles don't change. For example, if people say we can give credit without making money of it, that's a dangerous principle. But we can do that. We can afford to do that in certain other models, digital models, because the precedence has been set for a long time. And I'm kind of simplifying the whole thing, right? I was an e-commerce entrepreneur 15 years ago, and I've seen the other side of this. But I think these are some, I don't know if it perfectly answers your questions, but these are some things which kind of make us sort of pause and think. And when you come to the examples you just gave of Buku Warung and Ula, where we invested in Indonesia, I think the starting discussion, because there was a foundation and basis and reference points from India, was really around understanding the entrepreneur's thought process and asking them, hey, how do you guys think about this in terms of similarities with your counterparts in India versus the differences in terms of how you guys will build the company. And frankly, it was an easier conversation because it's more around the philosophy and thought process and approach of the entrepreneur. It's less about sort of the market and opportunity at this stage. If we believe, we obviously are looking at it because we believe in the opportunity, but it's really a lot more around that nuance of what is it that the entrepreneurs are building towards.
Sure, I think that's actually quite interesting insight, Ganesh. I do want to spend few more minutes on the same topic. Because neobanks are pretty hot. I was part of another panel where we have 4 neobank founders, and they expect 4 to 5 unicorns to come in India. And it's not 2,000 neobank. There are like more than 35 neobank. So I want to pick 3 things based on my observation of ecosystem as well as your investing style. So we had Paytm, which was probably 31st to 32nd wallet. We had Razorpay. Razorpay was one of the late entry in payment gateway space. Extremely beautiful product. Today it's unicorn. We also seen you guys making pretty late investment. IndiaMart, a company which was 16-year-old when you guys sort of made the investment, right? So the way I interpret Ganesh is that you guys are a thesis-driven investor and not necessarily FOMO-driven investor. Ki, hey, sector is hot, we should do that. So my question, just to ensure that audience and especially young entrepreneurs who are doing neobank, they benefit. So is it sort of fundamentally you believe, given the way regulatory system exists or the banking system exists in India, you think neobank as a business model probably would be less successful in India, or you think maybe you would let the heat go out, you would wait for maybe 1 or 2 years, you're multi-stage investor, so you probably could look at the sector 1 or 2 years later, or whenever a right entrepreneur, a beautiful product come up to your way, given your extensive experience of investing in neobank across other countries?
Yeah, that's a very good question, Devendra. So I'll just clarify a couple of the points you made and then answer this question. One is, yes, you're right about IndiaMart, but there are 2 differences. One is IndiaMart's the current business model really started in 2008-9. So it's more. So when we invested, it was still it had still been around. The new model had been around for 6+ years, but they had never raised a Series B. So what we invested in was Series B, which the round we co-led, which became the pre-IPO round. And very few companies in our country have been in that fortunate situation, and their profitability expanded phenomenally, and they went public, and the rest is history. But to your point, it was still a Series B round. So the total they raised before going public is 30 million, right? And it's probably the most efficient public company in the last 10 years by far in the country in the tech digital space. On a stage, yes, we are multi-stage, but our focus is a lot more entering at pre-Series A and Series A. So your question is very valid on, if all bets are made and positions are taken, how do you guys think about it?
Yeah,
I think there are a couple of things, right? And this also comes, if you look at our team collectively, I mean, we have all been entrepreneurs. We have all been also investors now for anywhere between 10, 12, 15 years. So we are fortunate that we have to be thesis driven. We don't have a choice. That is one, right? Secondly, given we are specialists, we also cannot have or do not have, thankfully, the kind of loss rates that a typical venture firm would have, because we are supposed to be specialists in the space, and that is what differentiates us. That's why all generic VC funds, PE funds, our partners, co-investors, founders would want to work with us, right? So that is kind of embedded in us. Now, whether it's happening or not is a thankfully it's happening, as across our portfolio if you look at it. But that is kind of the philosophy and principle, right? We wouldn't make 5 bets. We wouldn't have 5 horses in a race like it happens in other situations. We have seen other firms do that. We will have the one horse in race, and we will have to. It has to come from our belief of knowing all the horses and then betting on one. In all markets, pretty much we do that, right? Now, to your question on how we think about it, then also we do not have to invest in every great company in every market, because we just cannot. In fund, we do 20 investments. We have 14 countries. Sure, India is probably the most prominent country, along with now Brazil and Indonesia. But when the heat is too much, we probably have to just step back and say, okay, we're probably going. If we start making decisions on FOMO, it will probably be a little too irrational. But having said that, I do not believe that neo-banking will not happen in India. How neo-banking will happen is, and frankly, I think maybe even out of scope of this discussion, because that's a very long discussion. Whether you start with the foundation of payments, whether you consumer payments, SME payments, cross-border trade, lending, savings product, how do you go about it? That's a whole different discussion, right? Or you are just a UI layer and you're going to be a neo-banking as a service, whatever. No, that's a different discussion. But it will happen. We will see the offshoots of neobank most likely in one or two foundational product successes, as opposed to saying from day one, I'm going to be a full service bank, because it's very hard for someone to be a full service bank without actually having a license and having the flexibility, and nobody is getting a license in our like not in the next 1-2 years, right? It's going to be a process and you have to earn your right. So we believe that in this cycle, there will be a next generation of players, or there'll be some players who will come from the left field with a certain product, which is time to see interesting product market fit, but the digital ecosystem and infra will also evolve. They can extend their services. So it's going to there's going to be another generation, or you might also see some folks coming from completely left field, which is unexpected. Like as we speak, we have, like you said, we have 3 consumer neobanks in portfolio, and we have 3 SME lending companies, one in Southeast Asia, one in Africa, one in LATAM, all morphing into SME digibanks as we speak. So we are patient. We'll wait. Venture firms and reputations are not built in short term. Credibility is built over a period of time. So we'll wait for the right opportunity. Not in a hurry.
Sure. So I want to talk about one interesting theme that came across to me when I was looking at your portfolio, which is let me call it FinTech of X. So few of your investments are not direct like FinTech. They are not in lending, investments, etc. One being, let's say, India Mart. Second being Arya Collateral, which is in agri. They do a little bit of, let's say, FinTech. Third being like Ula, which is in like e-commerce enabling. So how do you guys sort of, let's say, look at these sectors, and what kind of entrepreneurs should come to you guys when they are looking to raise capital? Because they hear Kona is a FinTech investor, but they're not a FinTech company. So in what scenarios they come to you seeking capital?
Yeah, great question. And yeah, I can give you a few more examples. We have Facili in Brazil, we have SocoWatch, which is like Ula in Africa. So that there are quite a few companies which are at interesting sort of in a crossover space now. See, when we started, like I said, the goal of Kona is to really, sorry, let me take a step back. There are three different things going on here. One is, when we started, we had to earn our stripes to then do investments which sort of are more macro and broader, or have a wider angle lens, as opposed to being very clinically FinTech. And so that was one point. This is also a sign of maturity of the organization in terms of looking at flexible models. But the second point is, as we said, our goal is to figure out how to drive inclusion, which will happen by backing innovations that help achieve some life goal. Like I said, whether it's health or food or education or commerce, so on and so forth, right? Now, also the third dimension of this is, we believe the world of transactional models might not last for long. As we move forward, the way the world is changing is the relationship with customers, whether consumers or SMEs, and the service you offer has to be in a context. And there needs to be a context for you to be sticky to them. So, for example, if you look at Arya, so Arya is an integral digital platform today, platform and principal, because they have a full-fledged operation managing warehousing and collateral. They also have which participates in Arya's digital platform, but they opened up the platform to others as well. But a significant leg of Arya is also providing warehouse financing, and the financing against the produce for the farmers. Now, are there people who can just independently go and provide financing to the farmer? Of course. But we believe that solving the complexity of the post-harvest cycle And this being a cog in the wheel there actually helps build a stronger relationship with the customer, helps the customer provide better value, because you can then help them also with the storage and at the same time their cash flow management. And so in that sense, is it a fintech company? I don't think so. But is a financial innovation helping, and it leads to it achieves an end goal for the farmer? Absolutely. And are we comfortable with that kind of an adjacent thesis? Absolutely. Right. So if you replace farmer, in case of Ula, it's a retailer. Very similar thesis as Arya. You are seeing this very similar dynamics. And Ula also provides flexible credit, digital payment options for the retailer to especially manage their inventory, manage their ordering, manage their payments to the suppliers, etc., more efficiently. So, but is it a fintech company? Of course not, right? But is it a catalyst to make the model succeed in the overall context of digitizing the distribution chain, retail distribution chain across the country? Absolutely. So I think we are also kind of as we evolve and see success as a firm, I think we also have latitude to back great entrepreneurs who are hopefully trying to build something that changes value chains and ecosystems, with of course financial innovation being part of it.
Sure. I'll still come to another interesting theme I observed, Ganesh, and my guess is probably that's not by design. That's more sort of an outcome, but you are a person who can better comment on that. So I observed in your India portfolio versus rest of world portfolio, each of your Indian portfolio company are founded by people who are senior entrepreneurs, either ex-entrepreneurs or CXOs. India Mart, Brajesh and Dinesh, Neo Growth, Piyush, Arya Collateral, Prasanna, SME Corner, Sameet, Fisdom, Subbu, all of them are either ex-entrepreneurs in this thing. While at the same time in other countries, you have better younger entrepreneur. Is it because you stay away from heat, you stay away from the competition, because of which you ended up making investments, or is it like you take longer time, or you purposely choose in India entrepreneurs who have domain experience? If you could throw some light on that.
Yeah, that's a good question. I think someday hopefully you will have better intelligence to help me answer that. I keep wondering about it as well, but I mean, it's definitely not for lack of speed, because again, we know this space. A lot of times we have a thesis. We would have seen most of the companies in the space, and when we see something we like, we dive deeper quickly. So usually on the speed side, I mean, we definitely are not guys who will write a term sheet in 24 hours or 48 hours. I mean, that's again, there is that spectrum of speed. We never want to and never will compete with that. At the same time, if you take thoughtful peers in the space, we are usually faster than them because we operate in this space, and we kind of, it's our job to have a better sense. So I don't think it's that, and I think that's probably also changing. I mean, we have one or two more investments which will follow through soon in the next couple of months. It's in works, and you will see that that's probably changing. So there is no inherent bias, frankly, but I think there is also some truth to the fact that the market gets so overheated that sometimes even before folks start companies, when they're thinking of something new, etc., etc., investments happen too quickly for us to then say, does it make sense? Like a very young company, if already a round has happened, or say you pull together capital, if we are trying to do pre-series A and the valuation is out of sync with where the business is, I think it becomes more challenging. But yeah, I think there is frankly no inherent bias. It is just, it's probably more by default than more accident than by design. And like I said, there are a couple of investments that are in works, and they probably are in a different mold, and will dispel this myth.
Sure. Could you comment on given you have a view of different countries, right? So could you comment on how each of these countries are shaping up with respect to their evolution in the fintech or digital financial inclusion, and also probably a little bit of underlying factors, just for better understanding of the audience.
Sure. So you'll be surprised. There are some trends we are seeing. So very similar trends across markets. Like if you talk about just the digital leapfrogging, acceptance of digital platforms like Facebook becoming a very common platform for SMEs to really distribute products, or for you to tap SME customers. Again, there are a lot of issues there, by the way. So I'm generalizing now because we're talking about so many countries. But whether you see India, whether you see Bangladesh, whether you see Indonesia, South Africa, Turkey, Egypt, Brazil, you're starting to see the power of vast digital platforms to source business, to promote your product, to be able to provide services, follow-on services, etc., becoming a lot more seamless. And it's moving much faster than we can imagine. And like every month, I hear one or two, several stories, but I'm amazed by one or two stories where I say, "Wow, I never thought this could be sold through Facebook, or this kind of a business can find customers through Facebook, right, or something like that." So it's just eye-opening, and this is happening across the world. Across the world in number of these markets I just mentioned. Secondly, on the fintech side and digital finance side, we are starting to see regulators in general becoming a lot more tuned in. So and some of this is also thanks to frontier regulators, the first generation regulators who made some big moves, including some of the evangelization by monetary authority in Singapore, and I'll come to UPI in a minute, which is kind of actually blown away the imagination of world, and we are seeing that in other markets. But generally, we are seeing a lot more progressiveness, like the regulator in Philippines, the regulator in Egypt, regulator in Brazil. We see movements, obviously, in India. One would, we hope for more, but there's definitely been a lot of movement. Regulator in Indonesia. We are generally starting to see regulators get a lot more tuned to, for example, financial education, fintech related, a crossover of digital finance and classic finance regulations around that, or just building overall awareness and systems to protect the consumers and SMEs. But in general, we are starting to see a lot of movement on the regulatory side as well. The third aspect is this whole payment infrastructure, what India has done. With, of course, I guess we still have lot of things being built on top of it, lot of experiments being done, etc. And at some point, I think one would also argue that we need to sort of let it stabilize and let the system run, and then sort of build next gen. But overall, it's been a great role model for the world. Number of countries are looking at building interoperable payment systems like this to kind of figure out how to make payments easier and easier, and make it more like have it become more and more of a utility. That does lead to some tectonic shifts in the world, because there are a few companies which are massively valuable payment companies, incumbents and new generation, and you are seeing them accordingly change the way they operate in number of these markets. So the beauty of digital services and financial services is that from a thematic point of view, there's a lot of similarities across markets. Where the differences are typically in on the cultural front, on the social front, and how consumers or SMEs in different markets react. But from a thematic, commerce, financial services point of view, we see a lot of commonality around the themes. The one and the last thing I would say is, but there are also a few areas where we see a lot of contradictory views, right? Like one of them, obviously, the which you don't do is crypto, and the whole thematic around crypto, blockchain, stable coins, DeFi, and how markets think about it. And I think we are seeing fairly we are not seeing uniform view of regulators across markets, or even the ecosystems across markets. And yeah, that's probably the most controversial today. But yeah, generally there is a lot of similarities and uniformity in terms of evolutions we are seeing across markets.
Great. I think you touched upon this a little bit in this discussion, but I'll still sort of, let's say, ask, what's your wish list from three segments of India? One is Indian regulators, second is Indian entrepreneurs, and third is your fellow investors in the ecosystem. So what would be your three wish list of these three segments?
Oh God, yeah, that's a very loaded question. So for regulators, it's frankly, compared to what we have seen in the past, the last 7, 8, 10 years have been a lot more evolutionary and progressive in general. And regulations don't move fast because there's lots to take into account. Technologies move much faster than the ability of regulators or human beings to just assess their impact, especially in the context of economy. So I think there's a lot of empathy across, because we work with regulators of the ecosystem that will exploit it. And the challenge then is it becomes very hard for innovations to become mainstream, which has the risk of, and again, the whole discussion on cryptocurrency is probably front and center on that, because you can step back and philosophically say, what was the value of gold before, I think, 16, 1700s? In fact, gold became a standard in the after the Second World War, or around the Second World War. If you and I were born 100 years ago, we wouldn't even know what gold is in terms of its value as a reserve, reserve asset, right? But sometimes as time goes by, we take some of these things as granted and for gospel. Again, I'm not here batting for Bitcoin to become the reserve currency, reserve asset. But my point is, I think some things we take for granted have not been necessarily around since the start of time. And we have to put guardrails and controls to not let innovation run amok. But if we do not entertain some of these things today, like for example, one of the states in the US, the state government of their environment is building an entire digital infrastructure around Bitcoin. Like you can register a company just with cryptocurrency today. You can start your initial transactions, all of that. ETFs have been launched in the US and Canada. We have large global financial institutions which are starting to accept payments on trade invoices, cross-border payments, etc., using digital currency. So the point is that it's not about encouraging these currencies, but this is becoming a more seamless and easier mechanism to then do greater things. Now, if you look at decentralized finance solutions, they're starting to get built on the foundation of stable coins, and stable coins don't go up and down wildly. So again, this is not a discussion on stable coins or crypto, but the point I'm making is, if we don't open ourselves to some of these innovations, we run the risk of being left far behind in the innovative, meaningful, impactful solutions being built on top of this. And so that's one area where we probably need to think about, or the way we approach innovation, not just crypto, but in general. The second, coming to entrepreneurs and investors, I frankly think I said this yesterday in an IVCA talk event we were doing. Nothing is as good or as bad as it seems. So I think despite the vintage of entrepreneurship we have in the country, I think the asset inflation and deflation is quite wild. And yeah. And the problem is compounded in India because the supply of capital in India is not going to dry up anytime soon. We are one of the few countries where startups, where investors from anywhere, almost anywhere, are welcome. And across the 14 countries, I see India as the most diverse set of investors from across the world. So and people are getting more and more excited about the market for good reasons. So supply of capital will keep going up, which I worry is going to lead to asset inflation, because the imagination of ecosystem is limited to backing to the top 5-10%. So there's huge asset inflation on top 5-10%, and sometimes for no good reason except for the fact that everyone wants to back the same horse, which is, by the way, taking capital away from unfortunately some other good companies which might be performing well but do not fare well on the spectrum of promise and imagination. So if you have performance but no promise and imagination, you are in a much worse place. No promise and imagination in terms of your articulation, then you're in a much worse place today. And I think it can lead to significant imbalance and to Hopefully not, but there is a danger of some spectacular failures which will not make us look very good as a market, in the Indian context. So I really think nothing is as good or as bad as it looks, can be interpreted in a lot of different ways. And but that is definitely the foundational punchline I'll leave us with on that front.
One last question from my side before I open the floor for audience question. And this question is a little bit more on personal side, Ganesh. So today, if I talk about today's era, I also graduated from IIT Bombay in 2005. And I think anyone from my batch became entrepreneur, probably it took like 5 to 6 years, right? So today, becoming an entrepreneur is nearly risk-free. You become an entrepreneur if you're from pedigree institution, you probably get angel funding easily. Talking about your journey, you went through a corporate experience. You did not one MBA, two MBA, and both from like incredibly prestigious institution, IIM Calcutta and Harvard. So if I had to sort of, let's say, put Ganesh 20 years ahead and like in today's world, what kind of journey you think the Ganesh 20 years ahead would take? He would become entrepreneur faster, or he would still prefer to go experience corporate, do an MBA, and become an entrepreneur?
Yeah, that's I'll have to think more about that one. I don't have nowadays time to think what I would do if I were starting off today, unfortunately, given everything going on. But and by the way, my HBS degree was very much focused on venture capital and entrepreneurship, the business school degree, and it was but I think it's it's challenging. When you are very young, it's challenging sometimes to figure out if you want to do something because it's the fad of the hour or the day, and it will lead to overnight fame, as the misplaced notion a lot of times is, etc. Or because you truly believe that you have the determination, grit, passion, etc. to go through the worst of entrepreneurship, which honestly you will have more than your fair share of than the best, because there'll be a lot of tough decisions, a lot of tough days, and few good days. You are the janitor to the founder, everything depending on what's not getting done in the company. So where I hesitate is, I think yes, there are great examples of young folks in college, etc., who become phenomenal entrepreneurs. But everyone is not born same. So to realize if someone at the age of 19, 20, 21, 22 has the grit, persistence, vision, excitement, enthusiasm, maturity to hire, manage, and everything, to say this is what I want to do and I want to build a great company, it's hard to come by. And well, few people might have that exposure in childhood. Like someone like me did not have that exposure. My family does not come from that perspective at all. So it probably took me a good part of my 20s. When we started company, I was 27 or 28, but it probably took me a good 5, 6, 7 years to kind of start understanding that. Now, if I had the perspective while growing up, and if I was being forced to think, fully appreciate what company building or entrepreneurship is, and you have to give 10 years to it before you start kind of really saying, yes, it's happened, 8 to 10 years, I would probably have, with that understanding, if you become an entrepreneur, that's great. Sure, you might hit jackpot in 2 years, but that is not 2 years. That's not what people should be counting on. So my question really to folks is, everyone has a different kind of mental makeup and maturity, and understanding of the world. Some people become wise at 20, very few, some at 40, 50, some at 60, and some never, right? So if you are able to really understand what you are good at and what drives you, I mean, it could be entrepreneurship, it could be something else, then you should jump at it right away. The challenge is how soon can you figure that out. And for some people it never happens, for some happens very quickly, but for most people it takes a little bit time. So it's really more about that. I have little bit of hesitation of this approach. Like you said, there is a very prevalent thought nowadays that obviously becoming entrepreneur in college is just risk free, or right after college is risk free, right? But my question back to folks will be, you have an opportunity cost, right? And for argument's sake, if I say you go and work at the best possible corporate in the space you reside in, or consulting, or wherever, the 2 years spent there from a learning foundation perspective might open up your eyes a lot more than saying, yeah, I'll just right out of college, or in college I'll become an entrepreneur. Again, some can, but in the discovery process, I'm not sure if a lot of people even are able to have the mind space and perspective and maturity to go through that discovery process. A lot of times it's a lot more based on peer pressure, and a lot of the talks and sessions people hear also very early in life about entrepreneurship nowadays. I mean, I just saw an edtech company which is actually now doing entrepreneurship skill development for high school students. I don't know, why can't high school students enjoy their life? If they are sure, some of them might have passion, let them go and do it. But we're not here manufacturing robo entrepreneurs at high school level, right? So some of that is kind of concerning. So it's really a discovery process. The sooner you can have it, the better. I think, yeah, if I go back today and I had the tools, I'd probably still have given it a couple of years before becoming an entrepreneur. And Kona is as entrepreneurial journey. It's my third venture, but it's as much of an entrepreneurial journey for us it's a different business. It's venture investing, but we started from scratch, from ground zero. We are making the same kind of hard decisions that founders do. How do we build our business model? How do we really go around being the preferred partner for founders? How do you think of realizing value in our business eventually? How do we convince LPs that they should invest in us when we say, hey, we'll go and find great entrepreneurs or something as a first time fund? So we grapple with lot of similar things. How do we scale the team? So all of those things are questions for us as well, and we still run with a founder mindset, right? Which is part of the reason why we have, I think, whatever credibility we have in the market is because of the fact that we relate at a founder to founder level from an operational perspective, because we have lived that in the past and we'll live that today.
Sure, I'll take the questions from audience. We have the first question is from Pratyush Patodia. Pratyush works with Aditya Birla Finance in data science. So his question is, a lot of fintech offerings in more developed economies, especially those centered around lending, seem to build their value proposition that is it a want product than a need product. So from your point of view, how reasonable do you think this view is towards growth or profit?
Sorry, what is the question? One product or?
Want product or need product, need-based product or want or wish-based product. And the corollary to that is focus on growth or profit.
Yeah, I think this is a discussion, never-ending discussion. But I think a number of our portfolio companies, the approach we have generally prescribed, and mature entrepreneurs kind of understand this. It's a balance. A startup cannot, if you want to make a profitable startup and kind of run on that, you will obviously have to compromise on growth and market leadership. At the same time, growth and market leadership without sound unit economics is really building a company on shaky foundation. So I think end of the day, it's a balance. In each sector, the balance might be different, right? Like if we take insurance and we have fully licensed insurtech, one of our portfolio companies, the only fully licensed insurtech in all of Southeast Asia, the company would grow probably 2.5x every year. And that's phenomenal in insurance because there is a capital requirement to support that kind of growth as well. And you have to, it takes vintage to understand claim ratio and all of that, right? Whereas if it's a payment company, let's say if it's a payment companies probably grow first year, first, second year, they'll grow 8 to 10x and then maybe 5x, right? Because you need to reach a scale. The unit economics is pretty standard in consumer payment companies. Well, not in India. Let's keep India aside. There's no unit economics in payments. But in other markets where there is still some economics left in payments, it's probably classic bips per transaction model. So the question is, what is the uniqueness about the offering? And how are you really embedding into channels? How are you removing friction to reach scale? You have to reach scale to be a market leader in payments, right? Because it's winner take all, usually, or winner take most. So it varies, and lending is not winner take all at the same time. So lending companies, if you're going to and lending is somewhere between payments and insurance. So it's a great question in that sense. But if you're going to over index on growth, let's say if you index on growth like you do in payments or in e-commerce with lending, it can be quite detrimental, because you have the risk of losing all your capital in lending, or a large part of your capital. Even if you lose 10% of your capital, you're done for in lending. So
Correct.
lending has that risk. It is not like payments or commerce. So it really very specific to the business and to the market competitive dynamics as well. So you have to balance both out.
Great. We have next question from Shashank Atri. He works with JP Morgan. So his question is, given you have a view of multiple economies, multiple countries, like we have UPI in India, which has made payment process quite smooth. What really stops to have something like worldwide OR, which can make payment across world pretty smooth?
Yeah, that's a great question. I think a lot of folks have thought about this over the decades. For starters, it will put a lot of people out of business, which is why it won't happen that easily. A lot of people, meaning professionals and large companies, etc. But also on a more serious note, it requires huge standardization across regulators, across payment systems in the world, and you have to see what is the incentive for private enterprise to do that. It's very hard for private enterprise, and for the governments to do it, it requires enormous level of collaboration to to make this happen, and the standardization from a regulatory perspective, as I said. And the fourth is, different markets are at different levels of maturity. Like India has UPI. 90% of countries in the world have, you still have to stand in queue. Like if I'm a small business wanting to make 3 supplier payments, I'll have to go to the 3 banks and make the payment in 80% countries in the world today, or 85%, right? So the infrastructure available in different countries is vastly different even today, and hence that bring them together to make it happen. Even if we agree that the political interests and regulatory interests and all of that can be kept aside, is not an easy task. Having said that, there are a number of companies working on frictionless payments across key corridors. I mean, that is a very favorite theme. There are a bunch of companies we are looking at in the space. But yeah, trying to have one system world over is probably utopia, which I think is easier said than done.
So Ganesh, I think we are nearly about time. So probably we have a couple of more minutes. So any word of advice, given your significant experience, for entrepreneurs or for us organizers from IIT Bombay Alumni Association?
No, I think this was a great event. I really appreciate you guys inviting me, and especially doing an event which is very much focused on an up and coming thematic. Is very relevant in today's world, and cuts across various needs in the sector. And great roster of speakers since morning. So congratulations on that. In terms of what advice I would give, I mean, I'm not great at giving generic advices. I usually try to spare people of that. But one thing I would say is, every time you look around the world in a very sincere way, if you want to do something new in life, not necessarily only become an entrepreneur, but anything new, if you want to start in a new sector, a new role, try out something new, or become an entrepreneur or whatever, usually coming out of a situation like this, frankly, provides the best opportunity. And another way to look at it is, actually, Warren Buffett always says, when people are fearful, you should be greedy, and when everyone's greedy, you should be fearful. So we are in some kind of a situation here today where there is some mix of there's a lot of fear, and there is some greed in certain, like, private and public markets, in the financial services, financial investor space. But otherwise, there is a lot of fear in the in various ecosystems at large, and real business ecosystems. I think it's a great opportunity for someone trying to do something new, because as we come out of this, the next couple of years are likely to be years where one can capitalize on a lot of pent up need and want and demand and essentials in the markets. So never a better time than this to really take that step forward if the folks have been rethinking their lives.
Thank you, Ganesh. It was lovely to host you. Thank you so much on behalf of IIT Bombay Alumni Association for coming and joining the panel.
Thank you. Thanks, Devendra. I really appreciate it. Glad to be here. Take care.
Thank you.